What's going on, traders? My name is Dylan Grech. Welcome back to the channel and welcome back to another episode of the Best Trading Strategy series, where we go out and find trading strategies that are commonly used on the internet, testing them, validating them in a quantitative approach to see whether they are cap or not cap, or in other words, whether they work or don't work. So today, we have a very special video because we are going to be testing the very popular MACD indicator, and we are not only going to be testing one trading strategy, but we are going to be testing three of some of the popular MACD trading strategies that I could find on YouTube. So by the end of this video, we will hopefully understand whether the MACD indicator is any good, and particularly whether these three trading strategies that utilize the MACD indicator are actually any good. So of course, make sure you watch through to the end of this video, because even if they do work or even if they don't work, I am going to be going through in detail the reasonings why they either don't work or either they do work, so that way you are better equipped to actually understand why these trading strategies do or don't work. So one final thing that I just want to quickly mention before we go into it is that what I've noticed on the internet and the change in, I guess, the trend of people that do watch YouTube and particularly trading videos out there is that people are actually really interested and really understand the value behind backtesting a trading strategy. Now, going back to when I first started trading, I would take somebody's trading strategy on face value, not really backtesting it at all, and actually going into my own real money account and actually trading their trading strategies, and they would actually not work. So people don't really fall for that anymore, which I have noticed in some of the popular videos that have recently come out, because people are watching videos which actually shows the backtesting process within that video. Now, the one thing that I want to mention is that although people on YouTube are backtesting these trading strategies, they're only backtesting them for a sample size of 100 trades. And in my humble opinion, I just don't think that is enough. So we are going to take it up another level. And of course, if you've been following my YouTube channel, you would know that this is coming. Instead of backtesting these three trading strategies with just 100 trades each, we are going to be testing these trading strategies with around 8,000 trades each. So roughly around about in total 25,000 trades we are going to be taking today to test this trading strategy out. How do I do it? Of course, if you've been following me, you would know that I am a algorithmic trader. I like to take a quantitative approach to trading. And so I do utilize coding for my trading strategies, which I have done the liberty for you today. I have coded these trading strategies up to see whether they work or whether they don't work, so that way we can get a very high sample size. So as I mentioned, stick around to the end of this video. This is going to be a very good one, and so let's get straight to it. So very first trading strategy was one that I did find on YouTube. Of course, as I mentioned, a very popular trading strategy, which was made by Data Trader. Now, of course, this trading strategy utilizes the MACD, and the MACD is set to default parameters of 12, 26, and 9. Now, this trading strategy also has an exponential moving average, which is this white line over here. And that white line is the 100 exponential moving average. So how the trading strategy is set up is that we are entering the trading strategy when there is a MACD crossover first. So that's the first thing that we check. If you've been following along with my videos, that is the trigger signal. So there is a crossover over here, for example, and this crossover is when the blue line crosses below the orange signal line. So that is a sell signal. When there is a blue line crossing above the orange line like here, that is a long signal. Now, of course, we know the MACD. There is also the zero line with the MACD and the histogram. It is relatively the same thing. It is the same thing. If the histogram goes from red, which is bearish conditions, to green, which is bullish conditions, that is a signal to go long. And then likewise before, this is a bearish signal. When the histogram goes from green to red, it crosses over that zero line, and that is of course a sell signal. Now that is the first thing we look at, is our MACD line, and that is of course the signal. And this is where the MACD is our bread and butter for this trading strategy. It is our main confirmation indicator. Now the second thing we do look for is price in relation to the moving average. So we are only going to be taking long signals when the price is above the moving average, and this is when we only take, as I mentioned, long signals. Now the opposite case is true, is that price has to be below the moving average to take short signals. So what we do for this example is we did have a crossover of the MACD line down here. We can probably see it a little bit better with the histogram. Price crossed bearish below the 0 line here, so that is going to be a sell signal. And then likewise, the exponential moving average is over here. Price is also below the exponential moving average. So we would actually enter a trade here. Now, if you're not familiar with TradingView, this is how we can see that we are entering a trade. And we can see that we have taken a trade here. So there's a short signal here. And of course, I mentioned I did code all of this up. There is a short signal here and we have entered the trade. We have, of course, entered short because all of our conditions are met. Now, the final thing that I'll just want to mention here is that where do we set our profit and our stop loss? Our stop loss is going to be taken from the previous swing high and the previous swing low. Now, I am using the indicator pivot high low with a period of 5 to actually get the swing highs and the swing lows. And if I find it here, pivots high and low, we can see that, let me just change all of this. I'm using pivot high and low 5, so we can see that our stop loss was taken from this previous swing high. So of course we're going short, so we're taking the swing highs, and this was at 83.675 for this example. So our stop loss is set by this red line here. Now our take profit is set at 1.5 times that. So there is a 1.5 to 1 risk to reward ratio. And if I put, that's the wrong one, that's for longs. And if I put a short trade there, we will be able to see that is, if I get it right, that will be, there we go, 1 to 1.5. So we are taking a 1 to 1.5 risk to reward ratio for this particular trading strategy. And this is true for all of our trading strategies. It doesn't matter where the swing high and the swing lows are. It's all taken from here. We work out the stop loss range first, and then we take 1.5 of that to get our take profit. Last thing, of course, is our money management or risk management. We are risking 2% of the account each and every trade. This is a non-compounding trading strategy. This is a fixed trading strategy. So we're taking 2% of the starting balance, which for this case is $50,000. So we're assuming we've got $50,000. We are going to be risking $1,000 each trade. So one other thing quickly is that what I noticed from when Data Trader was backtesting this trading strategy is that he wasn't taking into consideration alternating signals or exit signals. Once he's in a trade, then he's going to stay in the trade until either a take profit or stop loss is hit, or we get the opposite signal. So we're not exiting the trade on a MACD cross over or cross under of the opposite signal. Now, if that all sounded really confusing, this is what I mean here. So we have entered the trading strategy here short, and we can see here that although we are still short, we can see here that the MACD did cross over long. It did give a long signal here, but our exponential moving average and our price doesn't confirm for a long trade. So remember, for long trades, price has to be above the exponential moving average. So because that didn't happen, we of course didn't get a long signal. However, we also did not exit the trade. And that is what I noticed when he was backtesting the trading strategy, was he was letting the trade run. So that's just one thing that I want to mention. Of course, most people here are no nonsense Forex traders. You would know that this is probably a little bit of a no-no. However, I want to keep things consistent with how they backtested. So of course, this is a short example. Here's a long example over here. Price is above the exponential moving average. There was also a crossover of the MACD over here that we can see. We set our price from the previous swing low, which was, of course, 83.121, which is this red line here. And then we, of course, go 1.5 times that to get our take profit. Now, that's it for the trading strategy. How about the results? These are the results for this particular trading strategy. What I want to go through here is that this trading strategy made 8,113 trades. It also made a negative profit of a lot. We blew our account 5 times, actually. We blew our account 5 times trading this trading strategy, risking 2%. each and every trade. Now, this is the equity curve of strategy number 1, and we can see it is a very poor performer. We can see that it's consistent losses over time. Of course, if we wanted to see a good equity curve, it would probably be this, but flipped the other way around. So this is actually an epitome of a very bad equity curve, which is consistent losses over time. The one last thing that I just want to show you here is the win-loss ratio. So the win-loss ratio is 33%. So although we are making 1.5 to 1 risk to reward, we are also got a win-loss ratio of 33%. So it's not actually profitable over the long run. So this is the statistics, and this is for all 28 currency pairs for, of course, Forex, and this is for the 30-minute time frame. Now, I'm using the 30-minute time frame because this is the same time frame that was used for Data Trader's actual video, and I just want to go through this. This is over a period of the 1st of July 2020 to the 1st of July 2021. So between that time, we got 8,000 trades, and we have seen that it doesn't work. Okay, so strategy number 2, this is actually a very similar trading strategy to the previous one. And this one is, however, done by a different YouTuber with slightly different parameters and a different time frame, which was made by Trading Rush. Now, this trading strategy is very similar, as I mentioned, as it utilizes the MACD, of course, but also utilizes an exponential moving average. However, in this particular strategy, we are using the 200 exponential moving average, and we are also using an hourly chart opposed to a half hourly chart. Now, in Trading Rush's video, he does preference that this trading strategy works on multiple time frames, and of course the trading strategy utilizes a different moving average. So I thought this would be a very good comparison to see whether we do get better results to the first trading strategy, all by changing the time frame, but also changing the exponential moving average, some of the parameters. Now the MACD parameters is exactly the same. It's using 12, 26, and 9, so that doesn't change. What we are changing, of course, is the EMA and the time frame. Now another thing as well is that we are not changing the way that the stop loss and take profit is hit. The stop loss is taken from the previous swing low or the previous swing high, depending on whether it's long or short. Of course, if you're going long, your stop loss is below price, so you're taking it from the swing low. If you're going short, your stop loss is above price, so you're taking it from the swing high. We are also using 1.5 for our take profits. So wherever our stop loss is located, our take profit is located 1.5 times that. So for this particular example, I've got a long example here. Our long entry is this over here. I put my bars over here. Our stop loss will be located here, but our take profit, of course, is located here. And we can see we've got a risk to reward of 1.5. And we can see that it is, of course, being taken from this previous swing low, which is this location over here. So our stop loss is located from this previous swing low, and that value is taken across, of course, to here. Again, we are using pivot high and low to get our swing highs and swing lows, which over here we can see is 84.074. So the one final thing I want to mention is that, again, going through how they did backtest the trading strategies, they did not take the opposite signals if there was a opposite crossover of the MACD. So even though that we were, for example, in a long regime over here, it didn't really last long judging by the MACD line, and that did cross over again, and there was actually a few crossovers here. But we can see we didn't exit the trade, and that is what I noticed from how they backtested the trading strategy. They let the trade run until there was an exit of either a take profit or a stop loss, or we got a completely opposite short signal where there was a crossover of the MACD, but also price was below the exponential moving average as well. So the opposite signal for the whole trading strategy. Even though there was crossovers over here and there's a little bit of chop, we actually let that trade run until it actually exited the trade with a take profit for this example. So there's nothing else much that has changed, as I mentioned, other than changing the period of the exponential moving average and also changing the time frame. So did this one work? No. It didn't work. So it didn't lose as bad, but it's still a loss. So we did lose $200,000, and we did lose 4 times the account. We did also get 8,537 trades. So this is a very high sample size, again, on all 28 pairs. Our win-loss ratio did go up slightly. So previously it was 33%. This is now 35%. So there is a slightly better expectancy for this trading strategy. However, all in all, it still loses. And we can see that over here. Unfortunately, this one again is cap. Now, I also mentioned that this trading strategy was being traded on the 1 hour time frame opposed to the 30-minute time frame. So because it's a higher time frame, I decided to actually extend the date range of our test to get a high sample size again. So what we did was we tested this trading strategy from the 1st of the 1st 2019 to the 1st of the 7th 2021, just to get a higher sample size so the sample size could be consistent. Now, lastly, I just want to show you the equity curve for this trading strategy, and here it is. Now, it doesn't look as bad as our previous trading strategy. It actually looked rather, well, flat, or at least break even for an extended period of time. Now, actually, it was the last month that this trading strategy was tested on that it did find its worst result. It was actually between the end of May to the end of June. So in just 1 month's time, this trading strategy actually lost $100,000 in 1 month. That's not good, especially if you just found out about this trading strategy a few months ago and you were trading it. You would have blown your account in 14 days. In 14 days, because as I mentioned, it was a $50,000 account. So if you started here, if you did trade this trading strategy from the 1st of June 2021, you would have blown your account in 14 days. Because this is a $50,000 account. Not good. All right, traders, very last trading strategy. This is strategy number 3 of the MACD indicators strategies that I did find, of course, on the internet. Some of the more popular ones. Now, this is again utilizing the MACD. It's also utilizing a MACD crossover. It also has an exponential moving average. This EMA, I believe, is 100 again. 200. This is the 200 exponential moving average, but it's also incorporating the parabolic SAR, or the SAR. So how does this trading strategy work? As I mentioned, a crossover or a cross under of the MACD line. So this line here, for example, probably not going to have to, well, maybe I will then, I guess. I will come in here. We can see our MACD did cross over here. We can also see this from the histogram here. This is a short trigger. So the next thing we need to do is look at price. So we can see here that the yellow line is the exponential moving average. Price just went below this yellow line, which is the 200 exponential moving average, which means that we can look for short signals. As I mentioned before, we did get a short trigger signal from our MACD line over here. Price went below. So we, of course, are looking for shorts. This is okay. Now, the last thing we want to do, and this is where it's adding another element for this particular trading strategy, is we have another indicator, which is the parabolic SAR. And similar to the exponential moving average, we want price to be below the parabolic SAR. So the parabolic SAR, or the SAR, is denoted from these white lines, which is on the graph here. And these white lines, of course, is above price when price is trending. Now, what's really cool about the parabolic SAR and how a lot of people use the parabolic SAR is that this is used as a stop loss level. So before we were using price action, the previous swing high, previous swing low, for our stop loss and take profit from that. Of course, with this one, we are now using the parabolic SAR instead to set our profit and stop loss. So we can see here that when we do get our trigger signal, price is below the exponential moving average. Price is also below the parabolic SAR. We can then enter our trade, which is of course this candle here, and we set our stop loss at the parabolic SAR, which is this value here. The SAR was at this point here, and our stop loss, of course, is this red line here. Now, one other difference from our previous indicators, from our previous trading strategies, is that we are setting this particular trading strategy to 1-to-1 risk to reward. So when I enter the trade over here, I'm setting my stop loss at the parabolic SAR, which is this level, but then take profit at 1-to-1 risk. So when we do have a 1-to-1 risk to reward ratio, of course, we need a high win-loss ratio, because if we're risking 1-to-1, we want to make sure that our win and loss ratio is at least greater than 50.01%, for example. So we want to have a high win-loss ratio for this trading strategy for it to be profitable. So let's see if this slightly more complicated trading strategy that utilizes one more indicator can actually be profitable compared to our other trading strategies. My friends, I had high hopes. I did have high hopes for this video, but I have to say this is the truth, and I'm glad I am doing this video. But before I go on a tangent, let's have a look at the results. So the results are this trading strategy did lose. And again, we are losing 5 times the amount of our account. Again, we do have a high sample size, so we do have 7,800 trades. So that's a decent sample size. It's a lot better than 100. And we can see that over an extended period of time, this trading strategy did not perform. Now, one quick thing, again, we are on the 30-minute chart again. So we are back testing between the 1st of July 2020 to the 1st of July 2021. So 1 full year. And of course, in that 1 full year, we did actually have 7,801 trades. One final thing, however, is that our win-loss ratio did go up, and compared to our previous trading strategy where our win-loss ratio was only 33 and 37 or 38%, I believe it was, this one does have a higher win-loss ratio. But remember, the reason why it's got a higher win-loss ratio is because we did reduce our R from 1.5 to 1 to only 1-to-1 risk to rewards. And so how this works is because we're lowering our take profit target, it doesn't actually take as much price action to hit our take profit. So it's actually more likely to hit our take profit, of course, because we're not actually putting our take profit as high. We're not actually getting as much profit every time we do make a win. So we are losing the profit potential of our trading strategy. However, we are picking up slightly a little bit more win-loss ratio because it's more likely to hit that take profit, as we don't have to extend as far to, for example, 1.5. It's a lot easier to hit 1-to-1 R than actually 1.5 to 1 R. So that is why our win-loss ratio has gone up. However, as I mentioned, we do need to see something that is greater than 50% win-loss ratio for something to be actually worthwhile, particularly when you're only trading 1-to-1 risk to reward. And because we have less than 50%, we of course definitely have a dud. So this trading strategy doesn't work. And quickly, that's the equity curve. It's not good. So why did these MACD trading strategies not work when these people on the internet are showing and proving that these trading strategies actually do work when they tested them? So let's find out. Now, when we do go back into the charts and actually look at how these trading strategies do perform if executed properly, which for this case, I'm actually using, of course, the automation. So it is, of course, always going to be perfectly executed based on the conditions. We can see just in this cluster here, it's probably hard to see, but there is a lot of long, short, exit, blah, blah, blah signals that is going on here. Now, why is that? That is because we are getting a lot of crossovers and cross unders of the MACD line, which does make things a little bit complicated. And it's these periods of time when it's really hard to actually take trades. And this is what I noticed when these people were back testing these trading strategies, where they don't actually backtest the trading strategies properly, where they take into consideration all of this, well, mess. And it's because of all of this mess that these trading strategies tend to not work when actually trading them live. Now, the way these people were backtesting these trading strategies is what I like to call hindsight backtesting, when you could actually see these periods of time and you actually don't take any trades in here. Now, the problem, of course, is that when we're actually trading live, we don't see this period of time in our foresight. I'll put the replay tool on. That's better. We don't actually see what's coming up. Now, the replay tool, of course, you need the paid version of TradingView. I'm not going to go into that, but you don't actually see what's coming up here. Now, of course, hindsight backtesting, we can see all of this if you're not using the replay function. And this is what I saw and what I noticed that these traders weren't actually incorporating. And that was these periods of low volume, a lot of chop in the markets and a lot of conflicting signals. And really, you would be actually entering all of these trades if you were doing it properly. So if I played the replay function here, we can see, of course, that over time, we are going to be getting a lot of random signals. And we can see that there is a lot of chop in the price action. And now some of these, of course, would be winners. Some of these will be losers. And we did find in our back testing that over an extended period of time, majority of these trades were actually losers. Now, for this particular example, this was the trading strategy that only had a 44% win-loss ratio with a 1-to-1 risk to reward, which of course is not a good trading strategy. Now, what I wanted to demonstrate in this video, point number one is 100 tests for a back test is simply not enough. When testing the exact same trading strategy over a long period of time, we have found out that with about 8,000 trades, we found that it actually did not perform well. So 100 trades is simply not enough, and we want to be back testing our trading strategies very thoroughly and increasing the sample size. Now, if you are doing an automated approach, then of course this will be a lot easier. However, if you're not doing an automated approach and you are doing a manual method, well, then I don't expect you to go out and get 8,000 trades per trading strategy, but at least make it more than 100. And of course, if you do find some of these trading strategies, you're gonna have to do your own due diligence and you're gonna have to test these thoroughly. If you are manually testing, I would say probably 1,000 would be the minimum for you to even actually consider the trading strategy. Now, the second thing that I want to mention is that although I do appreciate a lot of traders out there now understand the importance of back testing, and YouTubers are actually testing these trading strategies, the way they are testing these trading strategies using a manual approach is, in my opinion, not the right way to be testing these trading strategies. They are using in what I call hindsight back testing, when they do see what's coming up in the future and then they do filter out some of those trades, which does lead to having a bias within the trading strategies. And that bias, as we did see, might be indicative as to the reasons why those particular trading strategies did not work when I was backtesting them. And the third and final thing as to why I wanted to make this video is to actually show you that even though people are backtesting these trading strategies with just 100 trades, you still need to do your own due diligence. You can't actually go out and start trading these trading strategies straight away, even though in the video title they say proven 100 trades or proven this trading strategy works. Doesn't matter which currency pair or doesn't matter which time frame. Still do your own due diligence and still make sure that you test these trading strategies yourself before taking anybody's word for it on face value. Even with these videos that I do make, even with the codes that I do produce and do give away, I still say that nothing is proven. Even if I'm doing it, I want you to go out and prove it for yourself. Don't take anybody's word for it on the internet. Make sure you're doing the work, because there's no easy way around it. You have to do the work yourself. You have to do your own due diligence, and you have to be convinced that these trading strategies that you are going to be trading have been tested and have been validated the way you believe is correct. So of course, should you be using these trading strategies? In my opinion, no. I'll actually be very, very surprised if anybody is using these trading strategies and are profitable with these trading strategies. However, I did only test these trading strategies on certain time frames that were, I guess, advised by the people that did create them. Of course, You're free to do whatever you want with these trading strategies, change the parameters, change the time frames, do whatever you like, and you might actually find something that is profitable. Should you be using the MACD indicator? Well, I personally don't use the MACD indicator on any of my trading strategies because I believe there are other better indicators out there. There are better trading strategies out there as well. If you've watched my some of my other videos, you would have seen that there are actually profitable trading strategies out there that do perform much better than this. So that would be a better starting point than trying to make this trading strategy work when really this trading strategy lost 4 times your money, and in 2 other cases 5 times your money. It would be very hard to try to make something that's really bad good. At least start off with something that's, you know, okay, and make it good. So that would be my take on it. So although these are duds, as the way this series goes, I always provide you with the codes of these trading strategies, and for this case 3 trading strategies, which I will release in the next video for this YouTube channel, which I will still go through all of the 3 trading strategies for you to code up for yourself to do what you will with them. Now, why is this important? Well, one, because as I mentioned, I want you to test and validate these trading strategies and maybe come up with your own trading strategies from these codes so that you can test them and validate that everything I am actually showing you is actually real. Even if you don't believe me, and even if you think I'm a big phony, the trading strategy I'm going to be providing for you, so you can go and test it to make sure that everything I am showing you is truthful. And that is where the transparency of this YouTube channel is very, very important to me, because I want to be 110% transparent with all of you. And now the final reason why I want to incorporate a coding video for these particular trading strategies is that I actually used a profit high low system to actually set our take profit and stop loss levels. I also used the parabolic SAR, which of course is an indicator, to set profit high low as well. So this is a much more advanced technique, particularly the profit high and low, which was something that was new for me to actually do, which I did come up with, and I did find a way and a workaround to do that. Coding price action is something that is very, very difficult, but something that I was able to actually come up with and do. So I want to be giving that away to you as well. So although these trading strategies were duds, there is a lot of value to be taken out of it if you do want to follow along and become a coder, particularly on TradingView. So next episode, we are going to be going through the code so that hopefully at least that way you can come out of this with some additional knowledge, so that way you can actually better yourself as a coder, a algorithmic trader, and of course a quantitative trader as well. So finally, if you are coming along to this channel and you are new to this whole algorithmic coding quantitative area or space, then my YouTube channel is a good start for you to actually start off with your algorithmic and coding journey. So I do have a playlist and a series where I show you how to code a no-nonsense Forex trading strategy, so that way you can test them out yourself with a very high sample size in a relatively short amount of time. For example, it probably took me a couple hours to code up all these 3 trading strategies, and to actually back test them, it took me 30 seconds. So that is the power of coding. It is very, very valuable when it comes to automation and taking an algorithmic or quantitative approach to trading. So really hope you enjoyed this video. I hope it was insightful. I hope you learned something from it. None of this is financial advice, of course, and I'm not recommending you anything. Me personally, I'm staying far away from these trading strategies. Have a good day, and I'll see you in the next one.